Hey everyone! Welcome back to the Real Assets Arcade today. We're tackling a question that confuses a lot of new investors. What's the difference between ETFs and mutual funds? These two are often lumped together, and for good reason. They both offer a way to diversify your portfolio without buying dozens of individual stocks. But they have some key differences that can make a big impact on your returns. If you've ever wondered which one's right for you, stick around because I'll break it all down in a fun, simple way. Let's dive in. Let's start with the basics. ETFs, or exchange-traded funds, are like the cool kids in the investment world. They trade on stock exchanges just like your favorite tech giants or sneaker companies. You buy and sell shares of ETFs throughout the day just like individual stocks. Think of them as baskets of assets, stocks, bonds, you name it, all bundled up into a neat, tradable package. Mutual funds, on the other hand, are a bit more old school. They're like that reliable mutual savings bank your grandparents used. They are pooled investments managed by professionals. Think of them as these financial wizards pooling your money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. Now, both ETFs and mutual funds offer diversification, which is key to mitigating risk and building long-term wealth. But the way they operate, how you buy and sell them, and even how much they cost, that's where the real differences lie. First up, trading style. Remember how we said ETFs are like stocks? Well, that means they're traded throughout the day. You want to buy, you want to sell, you hit that sell button. Instant gratification, right? Mutual funds, not so much. They only trade once at the end of the trading day at their net asset value, NAV. So if you put in an order to buy or sell, you're stuck waiting until the market closes to see the price you get. Not exactly ideal if you're the impatient type who likes to react to market moves in real time. Next up, the fees. Look, I hate fees as much as the next guy. And this is where ETFs really shine. They usually have lower expense ratios, which is just a fancy term for the percentage of your investment that goes towards management fees. Why are they lower? Because most ETFs are passively managed. They're not trying to pick winning stocks. They're simply tracking an index like the S&P 500. Mutual funds, especially those actively managed ones with those financial wizards I mentioned earlier, often come with higher fees. You're paying for their expertise, their research, their stock picking skills, or at least that's the idea. Let's talk minimum investments. ETFs, they're like the friendly neighborhood coffee shop. Come in, grab a single share, even if it's just a few bucks. That's right, no minimum investment required. Mutual funds can be a bit more exclusive. They often have minimum investment requirements, sometimes starting at $500, $1,000, or even more. So if you're just starting out and don't have a ton of cash to throw around, ETFs might be a more accessible option. And last but not least, taxes. Nobody likes surprises from the tax man, right? Well, ETFs are generally more tax efficient. Why? Because of the way they're structured and how they're bought and sold on the open market. You typically won't pay capital gains tax until you actually sell your shares. Mutual funds, on the other hand, can trigger capital gains distributions even if you haven't sold a single share. How is that possible? Well, if the fund manager is actively buying and selling assets within the fund, those transactions can generate taxable capital gains. And guess what? Those gains get passed on to you, the investor. Alright, let's break this down even further with some quick pros and cons for each. ETFs, pros, lower fees. This is a big one. Less money going towards fees means more money in your pocket. Flexible trading. Buy and sell whenever you want, just like stocks. No need to wait for the market to close. No minimum investment. Start investing with as little as you want. Cons are brokerage fees. Remember, you're buying and selling ETFs on an exchange, and that means paying those pesky brokerage fees for each transaction. Mutual funds, pros, hands-off investing. Let the pros handle the stock picking and portfolio management. Just set it and forget it. Professional management. You're tapping into the expertise of seasoned investors who, hopefully, know what they're doing. Cons, higher fees. Those management fees can eat into your returns over time. Less trading flexibility. You're stuck with the end-of-day NAV, which can be a bummer if you're trying to time the market, although I wouldn't recommend that anyway. Okay, now for the million-dollar question, which one is right for you? If you're all about keeping costs low, if you value flexibility, and like being in control of your investments, and you're comfortable buying and selling on your own, ETFs are probably the way to go. But if you prefer to take a more hands-off approach, if you like the idea of having a professional managing your money and you're not too worried about those higher fees, then mutual funds might be a better fit. Ultimately, the best choice for you depends on your individual financial goals, your risk tolerance, and your investing style. There's no right or wrong answer here. It's all about finding the investment vehicle that aligns with your needs and helps you reach your financial goals. Let's make this even more concrete with some real-life examples. One popular ETF is the Spider S&P 500 ETF, SPY. This bad boy tracks the S&P 500 index, which is basically a collection of 500 of the largest publicly traded US companies. Think Apple, Amazon, Google, the big players. When you buy SPY, you're essentially buying a tiny piece of all those companies. Now, on the mutual fund side, we have the Vanguard 500 Index Fund, VFIAX. Guess what? This fund also tracks the S&P 500. So both SPY and VFIAX are investing in the same basket of companies. The difference lies in how they're structured, how they're traded, and their fee structure. SPY, being an ETF, will likely have lower fees, but you'll pay those brokerage commissions every time you buy or sell. VFIAX, being a mutual fund, might have slightly higher fees, but you might avoid those regular transaction costs. See? Same underlying investments, different packaging, different costs. It's all about choosing the option that works best for you. And that's it, ETFs versus mutual funds explained. Which one sounds better to you? Let me know in the comments. And if you enjoyed this breakdown, hit the like button and subscribe to The Real Assets Arcade for more easy to understand finance content.